What if I told you a multi-million euro tax dispute, a real high-stakes mystery, all came down to the meaning of just two words? Well, it did. And the result was a bill so massive it's hard to believe. We're going to unravel exactly how a seemingly simple payment went so horribly wrong. Okay, let's just put this number out there. 16.76 million euros. Now get this. That's not a company's profit. That is the unexpected tax bill they got hit with. A truly shocking amount that tells you something somewhere went seriously, seriously wrong. So how in the world does a routine interest payment between two companies in the EU just explode into a penalty this big? What did the tax authorities see that the company and its advisors completely missed? That is the core question, and we're about to unpack it. All right, here's our game plan. First, we're going to follow the money through this kind of complex pipeline. Then we'll dive deep into the beneficial owner test. That's really the heart of the whole thing. We'll look at the court's final decision, see how this situation compares globally, and then wrap it all up with the one big lesson this case teaches us about business today. Okay, so to really get what's going on here, you've got to follow the cash. Because this wasn't just a simple A to B transaction. No, no. This was a carefully engineered financial pipeline, and it was built for one very specific reason. So here's how the whole thing was set up. You have a Belgian company, right? It pays about 39 million euros in interest to a related company over in the Netherlands. But, and this is the key part, the Dutch company didn't actually keep the money. It was legally required to immediately pass that cash along to the real lenders, a group of investors who weren't even in the EU. So why bother with all these steps? Why the complicated dance? Well, the whole point was to use the special tax treaty between Belgium and the Netherlands. That treaty let the interest be paid with a 0% tax rate. But here's the catch. The final investors, the ones outside the EU, couldn't get that 0% rate directly. That Dutch company, it was basically the magic key that was supposed to unlock that tax break. And that, right there, is where we get to the heart of the legal fight. The entire case, all 16 million plus euros of it, ended up hinging on the real meaning of just two little words in that treaty: beneficial owner. So, what does beneficial owner even mean in this context? See, it's not just about whose name is on the bank account that receives the cash. It's about who is the true economic owner, who really has the power to use and enjoy that money. Is the company receiving it the final destination, or is it just a quick pit stop on a pre-planned journey? That's the question. You can imagine the company and the tax authorities had two totally different stories. The company's argument was pretty straightforward. Hey, the Dutch company is a legal entity, it's in the Netherlands, it received the interest, the treaty applies. End of story. But the tax authority looked right through that. They said, hold on, this Dutch company is just a pipeline, a conduit. It has no real control over the money, so there's no way it can be the true beneficial owner. Okay, so who won this multi-million euro argument? You've got two very different interpretations. Let's get to the court's decision. And the verdict was a slam dunk for the tax authorities. The court basically said the Belgian company just couldn't prove that its Dutch counterpart was the real deal. The tax exemption was denied, and that huge bill, it was here to stay. So why did the court decide this way? Well, they saw a whole bunch of red flags. For starters, the loans were set up back-to-back with almost identical terms, a classic sign of a pass-through. The Dutch company itself, it had almost no real employees or functions, and it took on virtually no risk. It was also legally bound to pass the money on. When the court looked at the whole picture, they said this structure just looked artificial. It was created simply to get a tax break for investors who weren't supposed to get it. Now, you might think this is just some quirky Belgian case, but it's not. It's actually a perfect snapshot of a huge global trend in tax law. And to really see that, let's compare how this treaty was handled with how a totally different treaty tackles the exact same problem. So, remember how this went down in Belgium? The term beneficial owner wasn't actually spelled out in the treaty. That meant the court had to interpret its meaning. They had to look at other EU laws and previous court cases to figure out what the treaty intended. It was basically legal detective work. Okay, now let's look at a totally different approach. Check out the US-Japan tax treaty. They don't mess around with interpretation. They spell it right out. They have a specific rule that basically says, look, if the only reason this company is in the middle is to pass money to someone else who couldn't get the tax break, then it is automatically not the beneficial owner. It's what lawyers call a but-for test, as in, but for that person in the background, this whole structure wouldn't even exist. So what you've got here are two different roads leading to the exact same place. The method in the Belgian case was interpreting a vague clause. In the US-Japan treaty, it's an explicit test. The source of the rule was a court decision in one and the treaty text itself in the other. But the goal? Absolutely identical, to shut down these kinds of conduit arrangements. All right, so we've followed the money, we've seen the verdict, and we've looked at the global picture. So what's the big lesson here? What's the ultimate takeaway from this whole mess? It all boils down to this: substance over form. It's a huge shift. Tax authorities and courts all over the world are done with just looking at the legal paperwork. They're looking past the contracts and corporate charts and asking the tough questions. What's the economic reality here? Who really controls this money? And this all leaves us with a really tough question, especially if you're involved in international business. As tax rules get tighter and authorities get smarter, where exactly is the line between smart, legal tax planning and a risky arrangement that's going to get you in trouble? This case gives us a pretty clear hint. The line isn't just about what's written in the contracts anymore. It's about what's really happening with the money.